Good morning, everybody. My name's Kevin Arfield, and I'm the chairman of Avondale Corporate. And welcome to our webinar this morning, The Art of Business Valuations and Preparing for Sale. Those of you who don't know, Avondale Corporate specialise in emerging mid-market business sales. So that means valuations of 2 to 50 million, typically companies with profits of in excess of 350,000. I'm joined today by Tim Hardman, who's my co-director, who's going to be very specifically talking to you a little bit about the science, but also more about the art of valuations. And there is a fundamental difference. There is an art to them, and that's the real theme of this. We're going to talk for 20-25 minutes with some technicalities, just to give you a steer and create some foundations. But actually, after that, we're really interested in questions from you. And probably that's where we all gain the most value from these webinars this morning. We got up to about an hour, but please fire in your questions in the Q&A. I've actually also been sent a whole load here, which I will also try and run through. So there's lots and lots of questions and be good energy on that. We will be recording the session, so don't worry. If you've got colleagues that you want to hear it, you can just point them at our website or our recording. So good morning, Tim. After your panic on Zoom updating, you're in and relaxed.
Well, morning, Kevin. I guess the first question, is it working? Can you see me?
Yeah, I can see you. I've got no idea whether they can see me, of course, because anyway, move on.
No,
Tech, Zoom. Right. So Tim, I'm going to go the old-fashioned way and change the slides for you.
Yeah, yes, please.
Okay. Do you want the first slide?
No, stay put for just a moment. So do you want me to take over here?
Yes, please.
Yeah, okay. Good morning, everybody, and thank you for the introduction, Kevin. And yes, we've had some great questions in from the audience, so thank you very much for that. There are some sort of generic about how to communicate valuation simply, hearing other people's views and so on and so forth. So hopefully that will come through in this session for you. There are some quite specific ones, which I will try and weave a couple into the presentation. Some I may have to leave till afterwards. So if you've asked a question and we miss it, please nudge us and we'll try and come back to it specifically. So what I'm going to talk about this morning, Kevin, we have got a hard stop on this one. So Kevin has said to me he's going to keep me to time on this, so I'll do my best. But I want to talk to you a little bit about the principles of valuation. I'm not going to spend ages and ages on a long technical briefing because I think most people will understand the principles. I'm going to run through a tiny little worked example, which I think just brings in some common mistakes and perhaps how to avoid them. And then, as Kevin says, you know, the best piece of this is always opening up to questions. So we'll try and get to that as quickly as we can. Yes, Kevin, next slide, please. Okay, firstly, I wanted to look at the sort of primary methods talked about for valuing companies. And that brings in my first question, which I'll come on to. Do valuation methods vary by industry? I'll come to that in just a moment. But the first one on your list, and the second one on your list, I'm going to skip over because effectively it's not very exciting if the value of a business isn't more than the sum of the parts, which is what the asset or book value is. And liquidation value is frankly worse because it's very often in a distressed type environment, so you're possibly not even getting the value of the assets. So we're going to move past those. Discounted cash flow. I have frankly never ever seen it used in a real life environment. I've heard it talked about, but I've never ever seen anybody actually value a business using it. And my theory behind that is I think it's a very useful tool if you are investing in an asset, but you need a very defined outcome for what that asset will bring you. So let's take the classic sausage factory example. If you're putting in a new production line into your sausage factory, you already have one, you know the output, you know what it can generate, so you know the future revenues from it, you know the margin from selling sausages, and therefore by using discounted cash flow, which is a sort of reverse of compound interest, if you like. You can work the maths back to see when your investment will pay off. For a business as a whole, I think there are just too many variables, and that's why it doesn't get used. Multiple of annual recurring revenue is used in very, very specific scenarios, typically around software as a service, SaaS businesses. It is very specific to that sector, and I think it gets used where the classic scenario with software as a service is there is huge, heavy investment in the software itself up front. And then when you take it to market and it becomes proven, i.e. you're getting users who are paying you, the subscriptions are rolling through and so on and so forth. But very often it hasn't come into profit yet, because these types of businesses tend to have a bar they need to get beyond before it starts making profit. So a profit multiple won't work. So a multiple of annual recurring revenue, i.e. the contracted revenue, is sometimes used. But again, that's so sector specific that we're not going to focus on that today. And Kevin, if my memory serves me right, I think I have written a paper on it. So if anybody is particularly interested in it, I think that is available in knowledge base on our website. So
there are loads of guides and articles. There's huge amounts of stuff. So,
But about 2 years ago, I think I wrote a paper on it, which I used there. Sector specific, I will focus on a little bit when I move on to the next couple of slides. It is relevant, and people will look at that. And also the second one, sector comparables. People will also look at sector comparables. So they are relevant, but I think they all come back to the primary method that gets used by a country mile, I should say. And even when other methods are used, such as sector specific and sector comparables, still the multiple of EBITDA or EBIT tends to get used to pin it. So that's what I'd like to focus on this morning. Kevin, yes, next slide, please, Kevin. This one jumps into a sort of indication of the types or the quantum of multiples that tend to get used for valuations. This is not sector specific. And I think the thing you can see two things I think come out very clearly from this slide is, one is there is a huge range from lower end to upper end. The other is you can simply see that scale, i.e. the bottom axis being EBIT or EBITDA, tends to drive higher multiples. And that makes sense. You know, the small business making 100,000 profit is probably 1 or 2 or 3 individuals, in which case the business's success or failure is very reliant on a very small number of moving parts. Whereas as you start getting into 10s, 20s, 30s of millions EBITDA, there is probably an awful lot more structure, controls, processes, checks and balances, etc., in the business, i.e. in all probability, and I keep coming back to the word probability because none of these are absolutes, it is a lower risk investment. The other thing I would point out, and this sort of comes to questions I'll come to later, is these figures have remained incredibly consistent for decades. There has been very, very little variation through recession, through COVID, through Brexit. You see tiny fluctuations, but the bounce back is almost instant. So that just gives an indication. One thing I would say is, please don't print this off and use this as an absolute matrix. It is an indication, and a couple of examples. So we also get very, very wide variations in what different buyers or investors will deem to be the value of a business. So I've got a relatively small transaction at the moment where the lowest bid we had was a little under 3 million. The deal we are doing and going through due diligence at the moment, touch wood, is over 4 million. So that's quite wide. I had one 2 or 3 years ago where I think the lowest bid was 18 million. But the successful bid was mid-30s. So again, a very, very wide range in the view different buyers and investors will have on value.
So can I just heckle you for a second on this?
Yep.
Because you said it doesn't change much over the duration, but we've seen interest rates go up fivefold. One of the questions was, what's the impact of that on valuations? And so what are you seeing on the street?
Minimal impact. I mean, the interest rate question is a very, very good one. But if you are looking at the real impact an interest rate of 2% compared to 5% has on £1 million borrowing over, say, 5 years, the difference is sub £20,000. So when you factor in all the other variables around opinions on value and strategic fits and so on and so forth, I'm not seeing that a change in interest rates is making any significant difference.
We have seen a slight increase in deferred payment instruments, though, for selling, haven't we, rather than borrowing?
Possibly, but the other thing to bear in mind is very few of the transactions we do involve very much borrowing. So it doesn't kick in there. And what you tend to find is when you have these very wide fluctuations in the view on value, quite commonly we've had a buyer say, "Oh, to me it's £3 million for want of a better number," and that gets discussed. Well, because I'm borrowing this, I'm doing that, I'm doing the other, and the cost of, and that's all I can raise, and so on and so forth. Well, that's all fine and all absolutely valid. It doesn't then stop us selling the business to the person who's got £4 million in cash.
I can say, I mean, would you not say also interest rates slow the economy up? In slow economies, people need to do deals more because they've got to consolidate more, and there's less quality companies. So that's why values don't drop, because the rarity stays.
Well, you've always got that, and I mean, you must remember, Kevin, we were asked the question an awful lot during the recession: is what's the wider market like? Is it a good time to sell a business? Now, statistically, deal volumes were down enormously, but valuations weren't. And what I would say to people is all about your own business. It's not about the wider market, because in a poor market, for whatever reason, and whether that's driven by interest rates, driven by inflation, driven by anything else, if you are performing well within that market, i.e. outperforming your peers, there is an argument to say you're more valuable because you're doing something different and you're bucking the trend. So I think, yes, of course, interest rates are relevant, but it's very specific to very specific scenarios. And when we're looking to sell a company and we're talking to 2, 3, 4, 5 bidders, the ones that are struggling around interest rates are probably the ones that fall by the wayside and we don't do the deal with. Does that help?
Yeah, thank you.
So I think that probably covers that. So one of the things I think is clear through this slide is scale is possibly one of the largest influences on the multiple used in a valuation, but there are all sorts of other influences. So Kevin, if you could flip onto the next slide, please. And again, this is an indication of the sorts of things that might influence. This is not a sort of checklist for you to go through and tick. But on the left, in the orange, I've set out what I believe are the elements that every business has. Whatever size, whatever sector, every business has. I get questioned on, does every business have a plan? My litmus test is the guy selling the big issue. And I would conjecture, yes, he does have a plan. He plans to get out of bed in the morning and go and stand on whatever street corner it is and shout big issue at the top of his voice. It may not be a written plan. There may be a selling involved in it, but nevertheless, it's a plan. And then I find it's a useful tool because within this, you can look at the pros and cons, or the SWOT, if you like, of each element of the business. And the more you have that are positive, mitigate risk, etc., the higher multiple a buyer is likely to perceive is relevant to the business in question. But as again, I say, this is not definitive. It's not designed as a tick list. This is the art side of it that Kevin referred to right at the beginning. It's the sort of concept behind it. And do bear in mind, any investment is about risk and return, and a business is no different. It's a very complex one, and it has lots of moving levers, particularly if it's a merger where two businesses are coming together. So it's not just about the standalone, but still the same fundamental principle applies. It's risk to return. And then I want to here go to a couple of specific questions. So we had one individual ask, how do you value technology such as a platform used by clients? I think that's an interesting one. And I think it depends what the technology is and how mature the technology is. So in a mature environment, then that technology should, in theory at least, translate to profitability, because if not, why is it there? In which case you can go back. I'm not going to ask you to go back on the slides. I'm sure everybody can remember that the previous sort of profits to multiples, it would impact and the value would come through in that. I referenced SaaS businesses earlier, software as a service, where technology is the lifeblood, if you like. And that's where, in those circumstances, where heavy investment has been made in a particular technology, but it is proven, and that is the critical thing, i.e. it is generating revenue. Then a different valuation approach, i.e. multiple of annual recurring revenue, might be used instead of a multiple of EBITDA. But that is critical. And I take you back to the 90s. It was the tail end of it, but the dot-com boom, we did have people getting in touch with us saying, oh, I've got this great platform, or even I've got a URL, i.e. a website, and it's a great name, what's it worth? Well, the answer is nothing. Unless it's proven, unless it's doing something, unless it's generating revenue, it's nice to have, but why? So there's got to be the why, and it's got to be evidence. Somebody else.
So Mark, just contradict slightly on that. This is, if you like, you take your standard multiple on your other graph, and then you downgrade it or upgrading it depending on how positive or negative you are on some of these aspects.
Yep.
But we did sell a training business which had a great landing platform. That was its whole marketing. That translates to profit. But the fact that our client that was buying, the buyer, could use that landing platform to also increase traffic for their own training services meant we got way over the average EBITDA profit, just because they had so much traffic.
Which is why you have this very, very high range in low, mid, and upper end of multiples. So what's happening in that scenario is the platform is probably generating a continuity of revenue. It's happening by itself because it's happening through technology, not through salesman, director having to pick up the phone every single time they're trying to bring in revenue. It's just happening automatically. It's rolling, and therefore A, generating profits, and B, generating a much higher multiple. So yes, it's relevant. Yes, it's valued. Yes, the value is subjective, but it still gets covered in the fundamental principle of a multiple times a profit. It just creates a much higher multiple.
Yeah, because you got the right bar with we need motivation. So their strategy aligns with the multiple influencer plus. You don't know whether it's going to be graded or not, but if you get your auction right, you will, and that's when valuations become an art, not a science. So, which is a good point, Tim, because just on this, we've had the question: why do people like us insist on sharing with clients what we think the value guide is when we take a project? Because we just said with auctions we don't know, and sometimes we're very, very pleasantly surprised to get the right strategic buyer. But so why do you start with brokers? The question: why do brokers set expectations with sellers on theoretical valuation models?
If you don't mind a slightly tongue-in-cheek answer, that depends on which broker you're talking about. And I would suggest the motivations vary. But to give you a better answer, I think it's fundamentally important to give people a guide of what reasonable expectations may be. Because for somebody looking to sell, a failed M&A project, I think, is an absolute business disaster. It's time-consuming, it's expensive, it's distracting, and you don't want it to go wrong for those reasons. Equally, if there is something standing in the way of getting the number or the deal structure or wherever it may be that a seller is looking for, you don't want to be going back to market once whatever is standing in the way has been dealt with in 2-3 years down the line and be talking to the same people who went, oh, I remember that one kicking around a couple of years back. So it's one of those things you want to do once and get right once. So I think from that point of view, having a proper conversation with sellers about expectations and probability of achieving them is fundamentally important. I suspect the person who asked the question, and I don't know this is pure conjecture, may be a frustrated buyer who's getting fed up with spending time and money looking at businesses where price expectations are off the scale. And I can't, no, I don't really want to comment on what I think other advice motivations might be.
So there is a bit of the Foxton's model sometimes with business brokers, isn't it? Overvalue, win the instruction, but they're biased towards the sale. But can we just talk actually more specifically about this? Because again, it comes back to the art of value, which is willing buyer, willing seller. You know, we will give a price expectation and then hopefully, you know, based on the maths and the multiple influences, and then hopefully go and beat it because we go out on an offers basis. So the market decides, and that's critical. But the seller's motivations are really critical because it's willing buyer, willing seller. Sometimes you get sellers that, you know, doesn't matter what their business is worth. They've kind of got a sort of golf club valuation in their head as well, haven't they? And that's relevant. They're just not quite ready to sell.
That may well be the case, and it's the I suppose that the number, the price, is driven by one of two things in all probability, or broadly. I'm sure there's all sorts of areas of grey in between. But either there is a requirement for some reason, and I've done it literally over the last couple of weeks with a client where I've written a report which says this is what I believe is the low end that we could reasonably expect, and this is the high end of what we can reasonably expect. And I've given that report with the client's blessing to a very good wealth manager I know to say, please look at this and give the client what's going to happen for the next 30-40 years of their life with that number and that number, so they can make a decision whether this is the right route to go down today. Now that's going into a lot of detail, but I think it's important, and the client has made a decision to go ahead and look to sell. But I'd far rather give them an honest view and then turn around and say, no, not now, and then move on to the stuff you're going to talk about a bit later, Kevin, which is how do we improve, how do we enhance, and do some work around that. And I think that's far more important. I think the other motivator for the number, the value, if I'm honest, is a score chart. It's a perceived value. So it's not about requirement. It's about what I've created, what I've done, and I want to feel good. And I'm not criticizing this by any stretch of the imagination. I'm just saying be realistic about it, because I want to feel my life's work and my achievements have been valued. That's fine, but just know what you're doing. There were two other questions I wanted to refer to in this bit before we move on. Somebody asked, what influence on price does being a franchise have? It's difficult to answer as an absolute because it depends what franchise and what the terms of the franchise agreements are. But I would say in all probability, it has a negative impact on value, not a positive one, because typically most franchise agreements will have restrictions. So a buyer's hands are likely to be tied in some way, shape or form as to where they can go with this business going forward, and whether that's supply chain, whether that's geography they can operate in, whether that's freedom of marketing, branding, etc., etc. I don't know. That's specific to the individual franchise. But as I say, I think it's unlikely to enhance. It would probably do the opposite in most cases. And then the third question I had on this section, somebody asked how contracts for products and services with get-out clauses impact future revenue, turnover, forecasting, and sale value. I think on that one, I think most contracts have a get-out clause in some way, shape, or form, and whether that's failure to perform, or whether that's just the end of the contract term, or whether it is some sort of break clause. I would say, what's the history of it? So, you know, if nobody has ever exercised whatever clause it may be because the service is at a level or the contracts are well written enough, you know, it's unlikely to be an issue. If the business has a track record of people signing up for 12-month contracts and cancelling at 6 months, I think that might be problematic. And then what I'm going to do is just run through a quick worked example. And this is completely fictitious, by the way, with a lot of made up numbers, which I hope might be helpful in dealing with a couple of other things. So, for example, somebody asked, many IMs, information memorandums, add back a host of exceptional items over the year to improve the profits and thus increase the valuation. Discuss. Okay, I will. So if you could flip to the, yes, you've done it. Thank you very much. So this is just a little bit of an overview. It's a long-established business. You can see the numbers. It's a steady ticking over business, you know, not setting the world alight, but doing quite nicely. Typical of this sort of size, you know, a couple of shareholders, one full-time, one part-time. It owns its freehold because, you know, it's a family business and that's perceived as good for the family. Why keep paying rent ad infinitum when we can own an asset? Fine. It's got some equipment. It's built up some cash on the balance sheet and the shareholders are looking to retire. Now to come specifically to the add backs, if you go on to the next slide, please, Kevin. This, whoever asked the question is absolutely right. We see this a lot. And it is valid if done properly. And by the way, I've lumped in all of the sort of sins together. So this ends up being quite an extreme example, but it's got an EBITDA last full year's earnings of £1 million. Our seller is going, oh, but there's so much potential. We could do so much if. So next year, it's going to be making 300k more profit. The directors have been taking £250,000 out between them through salaries, pensions, what have you. And the sellers have a perfect picture of what the buyer looks like, and there are going to be £100,000 worth of economies of scale achieved after the acquisition. So their £1 million EBITDA has just turned into a normalised EBITDA or an adjusted EBITDA of £1.65 million. Plucked a multiple of 5 out of the air. So they've then multiplied by 5. They've added on the plant because that's theirs and that's tangible. They've added on the freehold and they've said, well, the cash is ours. And therefore they get to a valuation adding all that up of £9.7 million. Yeah, okay. Conceptually, I sort of get it, but I think they've done half the job. So on the left, I've left the previous numbers. On the right-hand side, I've put what I think should be done in this scenario. And I've highlighted where my figure differs from the figures that were set out by the original add backs. Well, firstly, next year's profit being 1.3, not 1. Well, why? You know, if this is doable, why haven't you done it over the years? You know, if we're mid-year and the current run rate is as historically achieved, well, is the profit ticking up by 70 grand, i.e. the 7% it's achieved on a historic basis? That's probably more realistic. Yes, I do think it is reasonable to add back directors' remuneration and pensions and other benefits, because with a privately owned business, they are rarely the commercial rate. So I would start by adding those back. I would not factor in economies of scale for 2 reasons, really. Number one, you're on a hiding to nothing as far as negotiation is concerned, because you turn around to the buyer and say, you're going to make an extra 100 grand, and the buyer says, no, we're not. Where do you go with that one? Secondly, even assuming the buyer is going to find 100 grand worth of economies of scale, it's because they have put in place the facilities, the capability, the what have you, to absorb certain core functions, i.e. they've already paid for it, they're not going to pay for it again. So I don't think that's a reasonable adjustment. But what they've missed is full-time MD and part-time administrator leaving and adding back leaves a hole. Somebody's got to fulfill those functions. So I've I've plucked £125,000 out of the air for that as some illustrative numbers. Obviously a greater judgment call would need to be made in a real life scenario as to what was appropriate. And the other thing is, yes, I believe it is correct to exclude the freehold from the enterprise value and say that's an additional cost to the buyer if the buyer wants to buy the freehold. But what I have allowed for is a property cost provision. And now whether that's borrowing to finance the property or whether it's the sellers retain the property in propco, in a pension, personally, and let it back to the company, there will be a cost involved with it. And I think one of the key things that differs from the family business going, oh, it's great to build up this property asset because it gives us security and so on and so forth. The typical buyer goes, commercial property, 5% return on capital employed, that's rubbish. Why do I want to invest my money in that? Because if you look at a multiple of 5, that's a 20% return on capital employed on a business asset as opposed to property. So the sort of buyer who is looking at this sort of investment probably isn't getting very excited by property investments. If they are, they're probably doing it completely separately and they're not letting one confuse the other. So that's why I would always separate that and adjust.
Okay, you've got just on this, I can see the difference in the two numbers, the 9.7 to the 6.85. But of course, you go out and offers the market decides. What you haven't put on this is really how deal structure impacts on that valuation when you go out to offers. And we've had a good question in, which is what value should be assigned to the length of the time of the founders. So if you were going out and doing this deal and you've got your guide of 6.85 and the sellers have maybe understood that it's not 9.7 from the other broker's valuation, but we're going to try and beat 6.85 and should do. Earnouts are a way of doing that. But what else? So what value is assigned to the length of the time? What is a typical time? Are we seeing more earnouts, those sort of things?
Well, we've seen earnouts for as long as I can remember. Or some sort of structure to the deal, whether it's a deferred payment, whether it's an earnout, whether it is contingent on certain targets being achieved, very often financial. Sometimes it's simply contingent on a seller remaining for a given period of time to facilitate transition. So there's a whole host of variations on a theme that can be used. I think for me, and the advice I would always give clients, and the conversation I have with buyers, and buyers do ask a lot, they ask us a lot, by the way, is your client prepared to accept a deferred payment or an earnout or some variation on a theme? And if so, what proportion of the overall value would they accept? Well, the obvious answer to that one is, well, I don't know, you haven't told me what the value is. So if you offer me £100 million for it, we're prepared to accept 80% of an earnout. If you're going to offer me 10 million for it, we're not. So you've got to look at the whole rather than anything in isolation. But the other point I will make to buyers, and this does then bear out in the deals we do, is we are comfortable to give you, Mr. and Mrs. Buyer, some comfort that the whole house of cards doesn't come tumbling down the day the seller walks away. So we're prepared to leave some skin in the game to give you comfort around transition and us, the seller, helping make sure it works for you. We are not interested in funding the transaction for you. We're not a bank. Does that help?
Yeah, no, that does, and it's different for every business. I've had one buyer, notably a few years back, that absolutely
Yeah,
refused to buy it with the seller in situ. They decided the IP was great. They liked the team. They didn't like the seller. He's an entrepreneur. He's a liability. He's all over the place. I'm like, yeah, maybe.
Deals are complex and have very, very many moving parts, and therefore it's very difficult to answer any one question absolutely in isolation from looking at the whole.
Okay, we've had another point here on your valuation guide here before we move on to the next point, which is freeholds can be sold as part of the equation. Would it not be legitimate to put in the cost of buying a mortgage and including the freehold in it, and just allow that in the EBITDA multiplier?
I mean, that's kind of what I've done here. So the property provision may be rent, it may be cost of borrowing.
Yeah.
The numbers stack up very similar, by the way, when you do the maths.
Yeah. Okay. Yeah.
So
At 5 times 25k, there's a reduction of 100 on something or 1,000 on the valuation, isn't it?
Yeah. I looked it up a couple of days ago just to double check, just because I haven't looked at this for a long time. But I mean, I think residential property averages a return of 4-point-something%. Commercial is running at closer to 5.6 or whatever it was. I can't remember exactly.
Okay. Why did the value of cash reduce? Sorry, I interrupted you. And then.
Oh, sorry. Yes, that's the other thing where I differ from the other valuation is this sort of free cash. There was 700 grand in cash on the balance sheet. Well, businesses need cash to trade. So a business is typically sold with everything it needs in place to trade. And that's why the plant is not a separate line item that's added on, because without the plant and equipment, the business ceases to exist the following day. So it needs to be included. The same applies to cash. It doesn't need all 700,000. And by the way, if anything, all I've done is a super quick ready reckoner on this one, which is the annual costs of the business, so i.e. revenue less pre-tax profit, or actually EBITDA, divided by 26, and that's 2 weeks cover. So if you haven't got a full-blown cash flow in front of you to do it properly, it's not a bad ready reckoner, assuming that customer terms and supplier terms are similar and are adhered to, i.e., 30 days, and customers and suppliers will pay reasonably on time. As I say, it's not how you would do it in a real life scenario, but if you just wanted a quick gut instinct as whether the business needed the whole 700k worth of cash or needed a lower figure, it's not a bad starting point.
Because most offers come in debt-free, cash-free, don't they? And for that, it's subject to normal working capital.
But I should qualify, cash-free does not mean all cash-free. It means X.
We had that client who interpreted us that we had to go and get out of the pub on completion. Do you remember that?
I do remember. He emptied the bank account.
Different for everybody. So Tim, that's really useful. I'm going to talk a little bit about preparing companies for sale. Is there anything else you want to sort of cover on that? And then we can also take some more questions. Yeah.
I'm just having a quick look to see if there's any questions I've missed. Yes, there's a couple I've missed, which I'll address very quickly, and then if others come in, we can pick up on those. So, is there a resource? There's 2 or 3. Sorry, somebody did ask about the relevance of listed company multiples to unlisted companies. I'd be cautious, because almost by definition, if we go back to don't do it, but go back to the multiple graph, almost by definition, listed companies are going to be off that scale, i.e. much bigger numbers. And we can see that scale drives multiple, and therefore plucking a multiple from a FTSE 100 company and trying to then apply that to a 5 billion revenue, £100,000 profit company, I just don't think is going to work. Now, you could go, well, companies in this sector seem to be trading higher than the average for the FTSE, for example. Therefore, we think this smaller version is probably higher on the relevant section of the scale than some others. Yes, probably correct or reasonable. But again, what you tend to find is it's not about an industry that has a particular multiple. It tends to be about facets of an industry. If you could flip onto the next one, Kevin, please. That mean by definition, there's lots of good stuff in here. So, you know, I don't know, facilities management, you know, it's all contract based. Clients are tied in for 3 to 5 years, all the terms are agreed, etc., etc. So it's incredibly forecastable and so on and so forth. So, you know, that might be an industry. The other one is, you know, managed MSP, managed service providers, IT managed service providers. You know, all the clients are contracted, and it's just rolling revenue coming in for help desk facilities, and then some bumps on top of that when somebody wants to re-kit out their office with new PCs or redo their networks and so on and so forth. So you'll find commonalities within sectors that tend to mean people will look at them and go, yes, there's lower risk here, therefore the multiple could be a little higher.
Yeah, is there, you know, one of the other questions, is there a sort of index? Because years ago you had the BDO Private Companies Index. But, you know, that shows higher multiples because it tends to be bigger companies that are announced than that,
yeah,
rather than smaller companies. Where is it now in terms of indexes and where to look?
I don't think there is one go-to resource.
Yeah.
Which tracked price earnings ratios for 30 years or something like that, appears to have stopped about 2 years ago. I don't know why. Yeah. You know, you can look at, I mean, there is, what's the name of it? PitchBook lists known transactions. So you can look at transactions that have taken place. Yeah. The issue you've got with all of this is, it's about knowing the full story.
Exactly. We've got PitchBook and mark to market, but you don't know what cash was included, you know, where the assets undervalued, and was it a high earnout? Again, multiple influencer.
Exactly. It gives you a headline. So it's only the very large transactions where you probably know the detail.
Yeah.
And as we've already discussed, taking the very large transaction and underpinning their multiple on a very small transaction comes with its own issues. And the small transaction, and by small, I even mean 10 million quid, you know, the data isn't published as to, you know, if it's a small company, it's probably audit exempt. So even their accounting information is not fully in the public domain to make assessments. And us human beings like to feel good. So when our mate in the pub or the golf club or anywhere else says, oh, I hear you sold that, how was that? Oh yeah, I've got 10 million quid for it, brilliant. And you forget to mention the fact that you actually got 5 million quid on day one, and there's another potential 5 million quid payable over the next 5 years, assuming you achieve 30% growth per annum, and so on and so forth. And all of a sudden, somebody walks away with this lovely piece of data which says, oh, you've got a multiple of 10 times. And it's just not accurate. You haven't got the whole picture.
Not English to ask what did you get for your company either.
Well,
no, let's talk about money.
And it's certainly not English to say, oh, stop telling corpies. What did you really get?
Yeah. So I want to talk a little bit about, assuming that you're happy with the valuation, probably don't need my bit, but if you're unhappy or you want to make it more, and you know you're a buyer or entrepreneurs and you're looking at how you increase the value of your own company, just some reminders and tips on what we call shareholder value strategy. I mean, as Tim was mentioning, when we manage expectations for sellers, one of the reasons we do that is that often, you know, someone's come to us and said they want to sell. We've said, no, you don't, you're not quite ready. And how do we make it more valuable? So this section covers some of that. And I think the first tip is really, do you own what we call vendor assist, that, you know, you can use a market maker to help you do it. Do you own due diligence on your own business? You know, it's all about risk. Buyers are very focused on quality. They are much fussier than they were in the 2008, 2009, running up to that period. Since the credit crunch, the amount of compliance and fussiness buyers have is significant. You will not believe the level of due diligence they will put your business under, and you will feel like you're asking or answering the same question 5 different times from 5 different due diligence advisors. If you are going to pass muster and get through a deal, you need to be able to answer all the questions and tick all the boxes on a green light basis. So why not do it up front? Bench test your own business. Are your contracts fit for purpose in an M&A situation? And are all your legal positions sorted out? In particular, I mentioned here finance in real time. On the deal Tim was looking at there, he was slightly dismissive of forecasts, but actually more and more deals are being done in the real time. What is the business doing now and what are the forecasts? I do think, we need to be very measured and demonstrable about those forecasts, but as many deals do have earnouts, forecasts become much more important. We just completed an EOT and I was very surprised that they couldn't produce a monthly P&L. And I sort of reminded my clients, I said, well, look, you've got a finance director. They said, well, we look at the cash. And I said, yeah, but, you've got to control the costs as well. And it's very easy for them to run away. And they did it quarterly, but you're going to do it anyway. Why not do it monthly? So a real key point from a value influencer perspective, being able to produce your numbers in real time, being able to create the underlying metrics to demonstrate why those numbers are doing what they are doing. Is that a cost per acquisition of a client KPI, for example? Are the forecasts sustainable? Can't be just, oh, well, we hope we're going to hit that. We're hitting it. The run rate is this. You can see the curve up, and the feeder to that curve is as follows. Because otherwise, if you're trying to use forecasts in a deal, people will always say, oh, no, that's a hockey stick. And it's well known, sellers always, so buyers always laugh. Oh, we're always presented with a hockey stick from the sell side team. And we're saying, no, a hockey stick can be valuable if it's demonstrated effectively and broken down with the right metrics behind it. So a value influencer is being able to go right into your numbers, model them, and demonstrate them substantially in real time. So again, that's doing due diligence on yourself, looking at your financial setup and tracking, and considering how you're going to present that to buyers. And again, looking long term, if you were looking 2 or 3 years in, I think it is obvious that businesses that are not, or that are rarer, they're not doing the same as the guys down the road, will be more valuable. So in our strategy work, we do look at, as a multiple influencer, how can you stand out from competitors? And often that is about identifying in a business where you're being a busy fool, and saying no to some of the stuff that just isn't on the high margins, and yes more to the stuff that is really working and we see the market dynamic growing into. I call it navigating the rivers of cash, but if you can look ahead and see where the growth areas in your market are and place your business in front of those, the market will drive your growth rather than you having to drive the growth. So there is some real work there around, do you need to be doing exactly what you're doing right now? Are all your services working? Are you also fighting on too many fronts? That is very, very common. We see people that have got, it's the old phrase, turnover is vanity, profit is sanity. They've got too many services. They're not doing any of them well enough. And therefore they're losing advantage. Whereas actually, if we narrow it down, we can focus potentially on the high margin ones which the market demands. You can actually make a huge difference to valuations well ahead. I think another one is the streamlining. Interesting talking about tech. Every business is a tech business. It's really, really important if you can use your automation, your tech. I mean, we now use AI in our business a lot. I know it's a bit of buzzword AI at the moment, but it does work just in research resources and so on. But I think that means that whilst we have slightly reduced some of our headcount, we've controlled our costs more, we're actually paying people more, so our retention's gone up, and we've had less cost in training. So streamlining may be about how do you remove the layer cakes in your business where you are not automated issuing, particularly also double touching. When we're working with businesses in shareholder value, it's really interesting how many companies are what we call cultural companies. So they're a village, everybody's helping each other, they're all covering each other's deficiencies. And then you've got the city, which is very commercial, roles and responsibilities, do your job, and we're going to hold you accountable. And if you're not doing your job, you're out. And actually, to increase value, you may have to move from being the village to the city a bit more. And for us, that's all about being clearer on roles and responsibilities, looking at where the double touching has occurred, and also shuffling it around a little bit. Quite interesting, again, how many companies, when you look at the job descriptions, they were issued 10, 12 years ago, they've never been updated. So this, well, who's doing that? Who's in charge of that? And who's accountable for that is often very sort of chaotic. So if you're going to streamline, there's some energy around that. But one of the points of that is if you do that work, can you create a more team-driven business, which is less dependent on you? One of the biggest multiple influences is if the owners are not the driving force behind the team, the second tier management is the driving force behind the business. And that's because it's lower risk for a buyer coming in. So the more dependent it is on you guys, the higher the risk, the lower the value. So the more team driven it is, the higher the value, and therefore roles and responsibilities and clarity and avoiding double touching and holding accountable are critical when you're looking at that streamlining. We've already touched a little bit on the legal stuff in terms of the due diligence. It's just going through building your own data room if you like. If you haven't got time to do it, we will do it for you. Bench testing it. Are the terms and conditions, are the supply agreements, have they got any change of controls, are the insurances right? All of those bits, the more you can tick and go green light, green light, green light, the easier it is for a buyer to come in and take it over. We're often asked, if you're preparing a company for sale, aren't you, causing a problem for the buyer because they've got less of a, stretch for growth? And the answer is no. Buyers want scale up. So the cleaner the business, the more team driven, the easier it is to buy from a compliance perspective, the faster they can scale it up. So they will value it significantly in the process of an approach. So when we're working sell side, we now do everything through marketing data rooms, and we're starting to present really almost the early diligence side of it. Because the other point of that is that it means you can find buyers globally. Exchange rates are good at the moment for international buyers. So, of our trade projects, we've probably got 4 at the moment that are international. So it's important that in the run up to a sale, you've bench tested it, you've proved that you can build that data, but also when you actually go to sale, you are doing it on that basis because you can then go global in terms of the market. So I'm going to, we've got loads of IP on preparing companies for sale and on valuations on our knowledge bank, but I'd like to sort of throw open to the floor and see if there's any questions you guys have got beyond what's been had. I know we've got one more in here, but also Tim, were any observations there for you on preparing companies for sale? What do you like? What don't you like about what I've said?
I think the hockey stick value, projections, hockey stick valuation, all that sort of stuff is really, really interesting. And I think forecasts and projections are relevant. How far you go into the future, well, there'd be question marks, and that will be need to looked at on a specific basis. But they've got to be credible. And I think that was the point I was trying to make in the worked example, is when a business has been running at 7% through its history, why is it going to hit 30% next year? Unless you've got something really credible and tangible that evidences that. And I think the other thing I would say is if you have the luxury of preparing 2, 3, 4, 5 years out from an exit, which we would always advise, where possible, try and do, get into the habit of actually writing budgets and projections and have some commentary around them. Because if you can create a track record of hitting them, and particularly with commentary that certain events have occurred, hopefully planned, designed events, then all of a sudden your future projections become credible or more credible. And I think that's very, very valuable.
We call that being sale ready anytime. And actually it's really important, isn't it? Because you never know when the door's going to knock as well. I mean, okay, you can go open market, but acquirers are looking for high quality companies, you may get, the right strategic direct approach, and I mean, we can help you negotiate it, but you've got to be sale ready. And it's an important part of your boardroom discussions, if you like. We tend to find a lot of boards when we talk to them, how often do you have a board meeting? And it, once a quarter or once every 6 months, and they are very focused on operational, but they're not looking at this sort of stuff, which is, strategy really. And it's really, how do we create a shift in the leadership team's time so that, the second tier understand that they may be managing a multiple. How do we make the revenue more recurring? How do we demonstrate those forecasts going forward? Tim, you've had another question on the example you gave, which is, in your example, you added the freeholders an additional asset. Was this example just an office? If you have, say, a factory which is integral to the business, is that also added on separately, or should it be reflected in the enterprise value via the multiple?
Well, it is, because what we've done with that, if we've said, whether it's an office, whether it's a factory, what have you, the principle is the same. Is the buyer may or may not want that freehold asset. I'd say the vast majority, or the majority of the case, the answer is they don't, because it's not the best return on capital employed, but they might do. So what we've done is allowed, if my memory serves me right, I think we allowed £25,000 property cost. Now, whether the buyer buys the property as part of the deal, they will probably want to factor in cost of borrowing against it, because you can relatively easily raise against a freehold property. If they're not buying it and you're granting a lease, then there will be a rent. So what we're doing is allowing a cost which will cover off either scenario.
That makes sense. Tim, as you know, I've got a hard stop. So I'm going to say thank you for your time today. I'm putting up Tim's contact details and mine, but I think, on valuations, we really don't bite. We're market makers. We're very happy to chew the fat early on, give you some observations, value tips, and also I think a gap analysis. What's it worth now? What could it be worth? All incredibly useful for strategy for leaders. So please email us if you've got more questions. We'd love to hear from you. Tim, that was incredibly useful. Thank you for your time this morning, and much appreciated. We will be circulating the questions and the webinar as well, so don't panic. You don't need to hang on to your notes, but thank you all very, very much for joining in today. Tim, anything you want to say as a finish, or?
Yeah, final point. I don't appear to have a phone number, but my full contact details are on the website.
Thank you all.
Thank you all. Have a good day.